Hello, I welcome all the viewers here again today on another video on REITs and InvITs by reitspro.com. And if you have not been familiar with REITs and InvITs earlier, you can pause here and see what it is all about. You can visit our channel and connect with us also. So again, I'm introducing myself. I'm Gaurav Jain and I am also an author of these two books here, the details of which you can get on our website as well as on various platforms like Amazon also. So the question today is post budget. What should I do? Should I invest in REITs and InvITs? Because our last video was about telling you the impact of the budget on REITs and InvITs. So today let's try to answer, should I invest in REITs and InvITs now? So you could actually fall into three categories. I feel these are the broad three categories I've created here. So the reactions to budget is the first category, which is a disillusioned category. So they would say they are not streamlined yet, so let's avoid REITs and InvITs. There is the second category which would say it's an opportunity, let's grab it now. And the third one would be the careful or the unsure one who'll say let's see, let's wait and see what happens further. So there is also a discussion group we have, and we have members who are connected, and on this group the link is given in the description of this video. You can subscribe to our channel and then join our discussion group also. So what is the post budget scenario? Let's find out that first, that what is the post budget scenario for REITs as of now. If you see the legends here, the red one is the taxable portion and the green one is the non-taxable portion. So pre-budget this was the situation, post-budget this is there. So this is with a question mark here, this legend. The three REITs, and accordingly it's the bifurcation into interest, amortization, dividends and the total distribution is given. Earlier the taxable amount was on this column, now the taxable amount is in this column. So assuming a 30% tax bracket, your post-tax amount earlier was 96%. So if you've received 100 rupees, 96 would be the post-tax amount, and 98 and 85 with this tax bracket. Now the post-tax amount of distribution now would be this. Similarly, if we go on for InvITs, we have the similar table here worked out here as in REITs, and you have Indigrid, IRB and PG InvIT, and you would have the total distribution on this column, and again with a 30% tax bracket you would have had these kind of post-tax amounts earlier, which are now this much. So you can evaluate on your own basis and on your tax bracket what it works out to. So for that, you can just pause on these two and see this impact, but we also have a Excel sheet which you can download from the link given in the description, and you can fill in your own tax brackets and see what is the kind of impact it has on you. Now the question, what should I do? Let's explore that. So if you're the first one, the disillusioned one, and you are saying that they're not streamlined yet and let's avoid them, then let's go back to the year 2004 when the STT was introduced. So the market was really disillusioned at that time. Similarly, when the long-term capital gains of 10% was introduced in 2018, the market was very disillusioned, but it all changed over a period of time. So it happens, these things happen, and either we wait for changes to be rolled back or we just continue with them and adjust ourselves accordingly. So that's for the first question for the disillusioned ones. The next one is the opportunistic and the grab now ones, or the ones who are careful about it. Okay, so here these are the kind of questions that I generally encounter. So how much should I invest? What should I do? SIP or lump sum? What should I take, REIT or InvIT? Percentage allocation and a small case. So to answer these questions, let's look at the product in a little more detail. So this is a diagrammatic representation of what REITs represent. They are generally called hybrid product and a little complex, really. I mean, I don't know, but then they seem to have a mix of fixed income and equity. So they would yield regular cash flows and appreciation. That's the basic outline of what the product is. Now, what I understand, I am sharing with you what my understanding is. It's actually a simple product, but the structure is there which passes on rents to the owners of realty assets. That's what it really is. So this could be REITs or infrastructure assets and all. So yet this simplicity has in it a built-in flexibility. So you get features of debt, equity and real estate, all three rolled into one. So this is the kind of flexibility every investor can get when one invests in REITs and InvITs. Now, the answer to these questions would probably be, I would share my perspective that it's a beautiful product and it gives a lot of flexibility. And it could suit different mindsets and individuals with different and with multiple goals. So why take away something from it by standardizing it? But then we also need answers. So if you're an investor, you're looking at this instrument because it has mixed flavors. So the mixed flavors are all these. And then you need to assess on an individual basis, and that's what we should do. How can we assess it? So the answer here is, what flavor do you predominantly prefer as an investor? Okay, so if you look at, let's sort out the REITs and InvITs thing first, then what's good for you. So this is a table where I have outlined what a comparison between REITs and InvITs could be. This is just a small gist. You can pause here and see. So the type of assets there, the percentage returns, approximately the comparison, and the type of escalations and asset lives, infinite or not infinite, so on. You can pause here. Now let's look at it. Let's try to answer the question from the perspective of a person who's looking at debt more. So what do you want in a debt instrument? You want safety of principal, you want recurring and stable incomes, you look for high yields on the invested amount, and you want to hold a lot of people hold principal the principal to maturity. The loan is till maturity or long term. I mean, we are talking about long term loans. So the main point of view being debt, what do you have here? So what you should assess is what will be the REIT prices in the long term. So let's not look at the shorter term. Are cash flows from assets stay safe and stable? So if you see today, 7 to 7.5% is the kind of range for GOI and FD, and REITs are giving something like this, just as a ballpark. So distribution by current prices is what is there, and we've not factored into the income tax in this. The third is, do you wish to lock in at the current rates for a long time, and do you see any rise in interest rates and the impact adversely? So these are questions that probably nobody would have a clear answer on that. So I'm posing these to you. And then this, you know yourself, what is the tax bracket you are in. So in fact, if you want, you can take a call on whether you should invest now or later based on these parameters, plus a little more on your own thinking. The second thing is that what you really get is also a bonus, which is growing returns and principal appreciation. This is what would really beat inflation, which debt cannot, in all probability, over a period of time. The second way to look at it is from the point of view of equity. So an equity investor really looks for capital appreciation by entering at the right price, making money from market mood swings, and liquidating investments when profit are needed or when he feels the market's right. That's matured. So the equity investor would probably feel today, okay, let me assess whether the REITs are at near, or they are near the IPO price right now. So what is it really? What is the value right now as far as the market movement is concerned? So as we know, the capital appreciation in the past has nullified. So what is the direction? Could there be a major or minor? So that these are individual takes on what the market would do. And then what would be the overall market direction also impacts. So the macro level of how the market would impact things, because the funds are there in the market. So depending on how the market performs overall, this would also impact REITs and InvITs. And then one thing one also has to remember is that there have been no changes in capital gains tax in budget. So this is one part, and one should also remember that there has been no impact of any capital gains tax change. So this accordingly one can take a decision, but what the bonus that you are looking for in this kind of an investment, which you will be getting till that time, is high recurring income, as in case of dividend stocks. Now let's look at the third point of view of real estate. So a real estate investor looks at stable values of assets, recurring income which are predictable, high and stable, and growth which matches inflation. So the earning and assets should be able to beat inflation. That's the one of the primary goals. So the main point of view being real estate, we can think about REIT prices versus actual property prices. Has there been a change in last month? Then what about NOI, net revenues from properties? Has that changed? The future of REIT properties in India, what do you assess that as? And then you need to compare your views. If you've already bought physical properties, how would you have reacted? Also, let me just remind you here that service tax laws changed some time back to incorporate that in the commercial real estate. So that also happened, and what would you have done at that point of time? Earlier, if you'd bought physical property and this change had happened. So that's your investing decision here, and obviously the bonuses which are already there would be present, like vacancy avoidance, illiquidity is not there in case of REITs like in physical real estate, and bulk investing is not there. You can put in parts, and the asset maintenance hassles are not there. So this is an interesting probably topic, and maybe you'd like to know more. So you could express interest for a free masterclass in the link which is given in the description below. So summing up individual choices, number one, we've already discussed that there have been the disillusioned ones, and how the past changes have happened, and the markets and they themselves have adjusted over period of time. The number two, opportunistic ones would say grab now, and the careful ones would say let's wait. So the sum of all individual choices would boil down to this kind of a table here, where a risk return profile assessment is done taking an asset preference point of view into account, and the details and specifics as per investor conditions, outlook, taxation, and so on. If you like the video, please do write in the comment section, and write to us at support@reitspro.com. We'd love to connect with you. Thank you so much.